Howdy, Jacob here. Today we're going to do a one-off review on the Wendy's company. Sure, some people have heard of this. A little fun fact I heard the other day is that the current method of drive-through, where you order out the whatever and then go get your food driving through. The company that first did that was Wendy's. So, fun fact before we get to a little evaluation here, Wendy's company was founded in 1969. And I mean, just the fast food giant outside of McDonald's, Subway, I don't even know, other fast food places, Burger King, all them. So, Wendy's has uh, is their own company. I think a lot of other fast food restaurants are combined under. Um, is it BIN or another ticker symbol? But here we have Wendy's, where on the revenue side we see that there was some pretty big drops from 2013 to 2017, but then since 2017 has probably averaged about 6 to 7% compound annual growth rate on the revenue side, with operating margin pretty much the same and gross margin slightly down. Their dividend is paying out 5.5%, which makes sense given the fact they have a 4% return on invested capital. So people that can't get a good return on the money reinvested back in the business, it definitely makes sense to be giving it back to the shareholders. So that's a positive note there. Let's look at the balance sheet. Quite a bit of debt. I presumed a bunch of capital leases. Yeah, there's a bit of capital leases, but also just a pretty substantial amount of debt here. So 746 million cash and cash equivalents, with 29 million short-term debt and 2.8 billion long-term debt. Yeah, they have 1.4 billion capital leases as well, but that 2.8 billion long-term debt is quite a lot. Let's see what that is in relationship to earnings. So they earn about 200 million, and then on the cash flow side, yeah, probably right around 200 million on a 5-year average basis. So that's substantial. That is 14 times their 5-year average free cash flow. So that's not what you want to see, and it has doubled in the last 10 years from 1.4 to 2.8. So they look to be issuing a lot of debt here, and a lot more issuance than debt repurchasing. So we see that use of cash kind of all over the place. There were a lot of devastations from 2013 to 2016, which definitely coincides with their revenue declines there. Since then, just a tiny bit of acquisitions, really not a lot. Use of cash is very heavy on dividends and stock repurchases, and the company, with a 14 times their 5-year average free cash flow, should absolutely start thinking about paying down that debt. Obviously, this is just a generalization, but I mean, a company with that much debt should, one of the very first things they should do is absolutely go to pay it down. Obviously, if you have 14 times free cash flow debt due in 30 years from now, it's absolutely not a priority. But for the average company, that's not the case. There's a little bit due in a year, 2 years, 3, 5, 10, whatever. And so definitely the higher interest bearing debt and the debt that's due sooner should definitely start to be taken out a little bit, because 14 times is a lot higher than what I like. So I think I'm ready to start making some assumptions here, but I will be wary and point out that I don't have debt situated in my calculation, and so that's going to have to come into a factor on maybe your discount rate, or maybe tweak some other assumptions to be a little bit more conservative. But for me, on the revenue side, I think that I don't think that they're absolutely everywhere. So I do think that there's still growth beyond inflation, to where they could create some stores. And I mean, this return on invested capital is pretty cruddy. Like a Wingstop, a Starbucks can put down a store and get their money back in 2, 3, 4 years, whereas this would take 20 years. So not as fantastic, but all right. So let's do maybe 5% revenue growth, 15p in price to free cash flow. On the discount rate, obviously, let's do 15. I mean, they have a lot of debt here. Let's do 17.5. And I'm doing 17.5. Do what you want here when you do your own calculation. This is just them having so much debt that I'm just wary. So I just wanted to call that out. As for margins, they're fairly consistent. Let's do 12 and 11. And let's see what a 2% hit would do to their earnings. So 2.8, 5.6, 56 million. I mean, that would have a hit on their 200 million 5-year average. That's a 25% hit here. So let me actually bring these down to 10 and 9. What I did there is I basically looked at the average of about 13% and said, hey, 25% could get hit if they just did nothing else, but their interest went up 2%. It'd be about a 25% impact to their average free cash flow and earnings. So I just hindered their margins a little bit due to that. And then share change, I want them to be buying back less shares and start focusing on their debt. So with a 3.7 billion valuation, let's do 2% would be 7.4, 7.5. So 2%, that's 75 million of their 200 million is going towards that. And then with $1 payout, $1 a share, $1 over 18.2, just making sure that the thing I saw was right. Just their market cap, 3.8. Looking at 208 million. Okay, so it is. I'm gonna have to cut their dividend in half due to the fact that these assumptions are basically saying that roughly 40% of their free cash flow is going towards a dividend. Roughly, what was this one? 20%, 25% is going towards the share repurchases, and then the remaining 25% focused on that debt reduction. I mean, it's less than what I want, honestly, but I think I'm comfortable with these assumptions right now. So, yeah, hopefully you enjoyed the video. This is just my initial review. I'm definitely a little bit concerned about the debt situation here, which is why I factored in a little bit higher discount rate. But I mean, the company itself, if you see that the debt, because again, I don't do further reviews unless it gets closer, but if the debt is extremely far out, I mean, you could be in a better situation. That 5% dividend yield looks pretty great, but if you're looking at on what that payout ratio is on a 5-year average basis, it's over 80%. So I'd be a little bit concerned about that, given the fact that their debt is so high. If the company had no debt, a bunch of cash, obviously you can have a higher payout ratio, given the fact that if you have a down year, you can just go to your cash reserves. But there's definitely not a whole lot of cash here, given the fact that they're going to be paying out a lot for their debt. So hopefully you enjoyed the video and have a great day. Thank you.